All right. On Sunday, we're going to be back in our normal upstairs classroom. We won't be using Excel on Sunday. And you have homework 13, which is due on Sunday as well. Today, we're going to continue talking about inflation. Last time, we were looking at inflation in terms of present worth analysis. And today, we're going to continue looking at inflation. Oh, did I start the recording? Yeah, I did. All right. We're going to continue looking at inflation through the context of future worths and capital recovery. So any announcements, questions before we go on? That was the last quiz of the semester, by the way, if you're following along on the course schedule. So our next big assessment will just be the final exam. So we've already had our 2 midterms, we've had our 3 quizzes. So there's this homework 13 that's due, then 2 more assignments after that. So we're wrapping up for sure. All right, let's review a couple of these terminology things that we saw on last time. Now, the inflation-adjusted interest rate, we have I, which normally we've been using to stand for interest, and now we're assigning F as the inflation rate variable. And F is a percentage that we express as a decimal, and it's on an annual basis. And so remember that if you want to increase your purchasing power over time by putting your money in the bank, and presumably you're putting your money in the bank because you want it to grow, you want to share in the profits of the bank, and so that's why you're keeping it there. You don't want to put money in the bank and have it stay the same value over time or even decrease in value over time. And so if you want your purchasing power to go up, then this inflation-adjusted interest rate has to overcome the effects of inflation. So as a reminder, here's the formula that allows us to calculate the relationship between present value and future value when we have these 2 different interest rates. Now, I by itself is the real interest rate. So it's without any adjustments for inflation. The I is what represents your increase in purchasing power by itself. And then F is the effects of inflation by itself. And combining them together is how we get the I sub F. So the 2 parts of this relationship are the factor that accounts for inflation and the factor that accounts for interest. So today we're going to separate those 2 and look at how they each individually affect amounts that we're going to be calculating. So here was the formula that we saw last time in class, that you add the 2 together, you add the real interest rate, the inflation rate, and then you multiply them and add the product of that to everything else. So the banks themselves are going to be quoting a market interest rate. So if you look it up on their website, or if you're reading through the paper and you see the summary of the current deposit rates, what they are quoting is I sub F. They are quoting to you the inflation-adjusted interest rate. And the reason for that is they don't want to keep track of what's the inflation at every instant. And so they're just going to tell you how much they're willing to pay you. And so it's your responsibility to compare their market interest rate to whatever the inflation might be. And so it's up to you, for instance, to calculate I, the interest rate that would contribute to a real increase in your purchasing power. So as we talked about last time, sometimes you can lose money by putting it in the bank. Even if the bank doesn't fail, you can have your purchasing power decrease if the bank happens to be paying less than inflation. And so, for instance, if F is smaller than I sub F, so in other words, I sub F is more than F, then that's going to give you a positive increase in purchasing power. But if the market interest rate is less than inflation, like it is right now, in the UAE, if you remember the summary of most of the bank deposit rates and compare that to what you found when you were doing your research, during the project, most people were saying they were assuming an inflation of 3, 4%, maybe 5% if they really wanted to be careful. But none of the banks are paying that much. And so what that means is that your purchasing power is decreasing if all you do is put it in the bank. There's something called chasing yield. And that's a phrase that's used to describe what a lot of investors do, is they're chasing yield, meaning they're always on the search for good investments that will give them a higher return. And so it may be bonds, it may be preferred stocks, or it can be normal common stocks that pay a dividend. And so you're always trying to find something that will guarantee that you can overcome the effects of inflation, because unfortunately a simple bank deposit these days won't. So your purchasing power can decrease. Now, as I already mentioned, banks aren't going to quote the real interest rate. There's sort of two reasons for that, actually. The first is that it would be challenging for them to keep track of what is inflation, and it's constantly changing. But maybe the other reason that they don't quote the real interest rate is they don't want you to know the fact that if you put your money with them, you're actually going to be losing money, that your purchasing power is going down. They're hoping that people just won't notice that the market interest rate they're willing to pay is less than the inflation rate, because then people might put their money somewhere else, like a bond or something else that can come up when you're trying to chase yield. So what we're going to do today is we're going to account for future worth of items. And now, sometimes when you're reading through articles, it will talk about things in terms of dollars from a previous year. So for instance, if you talk about the price that was paid to build the Burj Khalifa, I don't remember exactly how much it cost, but let's say $1.2 billion. But those were $1.2 billion back in 2004. And so sometimes amounts will be quoted in reference to the year that it was spent. And then it would be your responsibility to say, how much is that in equivalent terms today? And so whenever you talk to older people, they're always talking about how inexpensive candy was when they were growing up, or how little fuel costs, or how cheap a car was, things like that. And so they'll be quoting amounts back in those days, and you need to inflate them into present terms. So there's two ways to account for that, and two ways to conceptualize how the time has eroded the value of money. One is you convert everything into constant value dollars using the inflation rate. So if you have a business, for example, and you know how much you're going to be receiving in the future, then you could discount those into constant terms using the inflation rate, and then use I in your calculations in the relationship between P and F. And so you need to separate the two variables. Remember that the market interest rate is I sub F. But sometimes you want to know how much is your real return, I. Lower just the I itself after extracting out the effects of inflation. So there's one opportunity for doing that. And then the other is you don't make them into constant value dollars, so you're not discounting them by the inflation rate. You leave them as their normal inflated dollars, and then use I sub F, which will be the market interest rate. You calculate what is that, and then after you calculate I sub F, then manually account for F by using this formula. So in other words, you can apply F to the money, or you can apply I sub F to the money, and then correct for the effects of inflation after you calculate I sub F. So this is abstract. Today's in-class exercise is going to give you the idea of what I mean by these two different approaches. Okay, so in part 2 of today's in-class exercise, what we're going to do is we're going to look at 4 different cases that are identified by the book. These are listed as methods for accounting for future worths. And the first one is you have to find out how much actually will be the balance in an account over time. Similar to how when you were working on the project, the last column in your summary table was the total balance of your assets. So it was the amount that's in your savings account or your investment account. And it was in terms of the dollars in that year, whatever the amount was in that year, so the actual dollars accumulated. The difference between case 1 and case 2 is that in case 2 you're just looking at the purchasing power, and so you're expressing that in terms of constant value dollars. So you're discounting the future amount to the present. So some of you, for example, said that when you retire, you're going to have 5.5 million dirhams, right? Something like that. Maybe higher, maybe less, but that was a pretty common number. When people were going through their spreadsheets, they said they were going to have 5 million dirhams. So what case 2 would say is take that amount and find out how much is 5 million dirhams worth in today's terms. So you would discount it to the present at the inflation rate. And that's what these expressions over here are telling you what to do. They're saying, for instance, in case 1, you're going to find the present value based on a future amount at 10%, where 10% is the market interest rate, where we have some inflation rate that hasn't been accounted for separately. You know, this I sub f includes the inflation rate of 4%. The difference between that and case 2 is in case 2, you're finding out how much is it worth in today's terms. And so maybe 5 million dirhams sounds like a lot, but in today's terms, that might only be 1 million dirhams. And that's still a lot of money, but 1 million dirhams to live on for the rest of your life, that may not be enough. Maybe it is enough. It's hard to say necessarily, but what this is doing is it's just separating the effects in 2 different steps. And so it's saying, first, you find the present value of the future amount, discounting at the inflation rate. Or what you can do, an alternate approach, is this 5.77% that they've listed here. That is the I, where you have saying this 10% is the overall market-adjusted inflation rate, market-adjusted interest rate. F is 4%, and so 5.77 is the real interest rate that represents your increase in purchasing power. The third case is where you are finding out how much you would need to maintain a constant purchasing power, and then case 4 is similar to the first one. If you look at the formula they're telling to use for it, actual dollars accumulated and future dollars to maintain purchasing power is kind of the same thing. It's just looking at either how much your investments are going to be worth or how much your costs are going to be. That's case 4. So I have given you this formula on your in-class exercise paper today because we're going to use it to account for capital recovery differences. Remember that the money that you receive today is more valuable than money in the future. And so what that means is that you're paying for something today with valuable dollars, but you're going to be receiving revenue in the future when those dollars are less valuable. And so you need to factor that in by finding out the annual amount that has to be received to cover the capital recovery. And remember, capital recovery has 2 components. It's the initial purchase price and the final salvage value. So here we're finding A based on a present value, some initial purchase price. And so you're going to have to use the capital recovery calculations to find out what is the market interest rate, including both the inflation and the real interest rate that is needed. Okay, let me give this paper so that we can get a good start on that. There's 2 parts. And in the first part, we're looking at the bank that I actually used back in the United States. They brag about having the nation's highest yield. This bank is bragging, and all they pay is 1.25%. No, they're not. That's just their market rate, 1.25%. I wish it was after adjusting for inflation because inflation is more than that. So I'm losing money on I'm losing purchasing power on the amount that I keep in that bank. So let's see how much money I'm losing by keeping my dollars in that account. In step A, everybody get a paper? In step A, what we're going to do is we're going to look at if you put in a $110,000 after 8 years, how much is that? You know, what is the account balance? Irrespective of how much you could buy with it, but what is the account balance? Now, in these previous slides, we've looked at the 4 steps here. So case 1, actual dollars accumulated, that is what A is going to be doing. It's going to be using the case 1. Okay, in part B, it's determine the present value of that future amount. So that is what we're going to be doing corresponding to case 2. We're going to find out the purchasing power of the $110,000 that I put in. So I'm putting in $110,000 now. After 8 years, what is that going to be able to buy me in present term dollars? Part C, the real interest rate, means you're solving for I using this formula because we know I sub f is the 1.25%. Inflation is 3%, so what is I? And then finally in step 4, asking what would they have to pay, what would this bank have to increase its rate to if we wanted the real interest rate, meaning I, to be 1.25%, assuming that the inflation rate stays constant. All right, so go ahead and get started on that. So part A is the amount that you'll actually have in the account, and part B is how much that amount is worth in today's terms. And so it illustrates that you're losing money. Because if you put in $110,000 originally, it's sort of like saying that $110,000 after 8 years is worth $95,000 in today's terms. So you'd be able to buy less things. Whatever it is you're saving for will be more expensive. You'll have $121,000, but the things you're trying to buy with that money are more expensive. The prices of things grew faster than your savings account balance did. So that's why that's what this $95,000 represents, is the present value of the future amount. Okay, now the one thing I'd really like to emphasize today is that banks don't quote the real interest rate I. They quote the market-adjusted interest rate, the inflation-adjusted interest rate I sub f. And so when they say they're going to pay you 1.25%, they will, but because inflation is higher than that, your real interest rate is negative. So you're going to have a decline in purchasing power as a result. So if you wanted to earn a real return of 1.25%, this is how much they would have to be paying, the 4.2875. That's what you should try and get for them on paper. All right, well, we won't have time to get through the rest of it. You can hold on to the paper, and if you'd like to look over it, then here's the solution to part 2. It's in the video if you'd like to see what I had in mind. This is the amount that you'd have to be receiving over time. So I hope you have a good weekend. I will see you on Sunday, and the scores will be posted on iLearn once I've finished grading the quiz.
Good.